Welcome to this Gillick Explains video, and welcome to a slightly technical topic, but one I think that I can communicate in a short video reasonably well and then give you some other sources to look at, and that is investing factors, all right, and how they can potentially help investors. They're not perfect, so they might hinder you as well, but how can they help you? So let's start from the top. Long-term investing is about what? Fundamentally, it's about generating the maximum return over a long period for ideally the minimum level of risk or an acceptable level of risk to you, reflecting your natural tolerance for risk, as we call it. And factors are one way of potentially achieving that reasonably easily. So what are they? Factors are basically common traits, things that certain groups of stock have in common, and basically that research, detailed research, academic research and so on, has identified as being potentially useful in investing terms. So these factors are literally common characteristics that mean a group of stocks could, in the right circumstances, outperform other stocks. And what's more, you might be able to get access to this strategy, this factor-based strategy, relatively easily. I'll come back to that point in a moment. Now, there is an industry devoted to factors and factor investing. I'm going to pull out 6 that have demonstrated their longevity, if you like. They're sort of backed by quite a bit of science and quite a bit of investing history. The past not being a guarantee of the future, of course. Size is one of them. So to just paint a picture, and you can find out more at the end of this video. Size, the size factor, as it's called, is the idea that small stocks often outperform big ones. And Farmer and French did a famous paper that talked about this and justified the reasons for it. And some of the reasons I've covered before. Why do smaller stocks often outperform over the long term their much bigger peer group, albeit the volatility along the way is much greater? There's the risk-return trade-off. Well, they're less well known, they're less well researched, they're not as widely held. So it is possible to get some sort of edge, goes the argument, in that market. And also they start from a lower base in a lot of cases. So there we have it, the size factor. Valuation factor next. The valuation factor basically says that cheap stocks tend to do better than more expensive ones. They are less frothy, all right? They basically have a lower base, as I mentioned before, from which to start from. However, simple as that is to say, buy cheap stocks, thanks for that, Tim, the debate then comes in, the value debate on what you exactly target. If you're looking for cheap, do you go for price earnings ratios, low PE ratios as a benchmark? Do you go for low price to book ratios? Do you go for something else? Do you go for a combination? So there is a debate about what cheap actually means and what is a value stock. All right. I won't get into that debate here, but nonetheless, the principle, the factor is cheap usually beats expensive. Common sense, and there are studies that demonstrate it. Next, momentum. Now, these factors, by the way, are not all totally consistent because in a market there's always more than one view, but this is the one that says the momentum factor says historically studies suggest the trend is your friend. All right, the market stays irrational for longer than it sometimes should. Exuberance takes over. So when there is momentum behind a stock or a group of stocks, could be AI at the moment, for example, basically it pays to stay on the wagon. Not to the point where valuations have gone crazy and it's just speculative froth, but nonetheless, run winners is the idea behind the momentum factor. Then there's the volatility factor. Now this says the opposite of what it sounds like. It says stable, lower volatility stocks tend to reward investors over the long term, and therefore, if you buy into the volatility factor, you're looking for strong business models, strong brands, a decent moat, a competitive moat. You're looking for tough stocks that can weather dips in the market and downturns. You're looking for the kind of things that Warren Buffett, Charlie Munger at Berkshire Hathaway would favor, for example, the kind of stocks that an investor like Terry Smith would go after, for example. Now, not everyone believes in their models. That's the point about a market, but that's the kind of factor you are trying to work in your favor. Next one is the quality factor. So there's a lot of research that suggests that firms that generate good profits and consistent cash flow, in other words, they can turn profits into cash flow. All right, and there's a ratio that looks at the balance between the two, will tend to reinvest earnings at a higher rate of return in the future. So high quality stocks tend to beat low quality stocks. Now, you might say it stands to reason, but don't forget with lower quality comes a bit more risks. There's a trade-off there. Then there's the yield factor, all right? And this one says that firms that regularly pay high dividends, and the number of those has dwindled in recent sort of decades, but nonetheless, what they are is firms where management have to be disciplined and have to be capable of turning profits into cash flow. Because the only way of maintaining dividends, so you don't disappoint shareholders, is to impose that discipline on the business. And that discipline is ultimately good long term, okay? And also it creates accountability. You know, shareholders can say, where's my dividend this year? Why have you cut it? What's going on? Now, there is a quick tour of 6 factors. There are others, all right? You'll notice they don't all follow the same theory, all right? So how do you access factors? Let's say you're quite interested in what I've just said. How would you go about establishing an element of, factor investing within a portfolio, for argument's sake? Well, you need to diversify, all right? Not all factors perform well at the same time, almost by definition. So diversification is key. And actually, in terms of access, if you're looking to follow a simple, well-defined strategy, you can do a lot worse than something like an exchange-traded fund, a passive tracker. There are exchange-traded funds, shares set up, simply designed to follow some of the factors that I've just identified. Right, there are active funds that will do that too, but whether you need to pay an active fund manager ultimately to set up something which just mirrors one of these factors is a matter of some debate. Now, big topic, lots of things not covered there. So to find out more, killick.com/resources is the new tab on the newish website. And there you can access other videos from me. You can access, if you wish to, a digital version of the guide sitting next to me, or you can access Confidant, the spring 2024 issue, contains an article all around what I've just spoken of.